in listen-only mode.
Good evening and welcome to tonight's Premium Account Live Market Update webinar. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. And the presenter tonight, myself, Leon Hine, current Managing Director of Global Equity Management. The format for this evening's presentation, we look at the global macro outlook driving equity markets. We roll through the ASX top 50 charts. We review PE valuations in light of sort of upcoming 2013 earnings and look at which stocks have reasonably bankable earnings growth out to 2013. We review portfolio construct given the recent volatility in markets and how we're positioning portfolio allocations and the derivatives book, and we conclude tonight's presentation with the short-term Australian market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Moving straight into a graph of the Nasdaq, which is not sort of the normal procedure for the macro outlook, but the short-term news that's just influenced market, and I suppose in light of Facebook occupying a reasonable amount of media attention this week, I thought I'd just include a snippet on the Nasdaq. So the Nasdaq Composite Index rose the most since December in last night's trade as hopes of political progress in Greece and talk of government efforts to buoy China's economy trumped a steep decline in Facebook's newly public stock. So if you're not aware, Facebook fell roughly 11% last night. The tech-heavy index jumped 68 points, or 2.5%. It's its biggest percent increase since December 20. Moving into a graph of our sort of more common indicator or barometer for the macro view on global equities is the Dow Jones, and again moving to the short-term data, the Dow Jones average climbed 135 points last night, avoiding a 13th loss in 14 sessions. Interesting of note, JP Morgan fell roughly 3%, but more importantly that they suspended its share purchase program, and that's something over the coming weeks I'll just chat a little bit more about at a macro level, the US banking sector. At the meeting of the group of 8 major economies, several European leaders showed their support for the issuance of a common bond by the Eurozone government, which helped relieve some of the pressure from peripheral economies. So two sort of short-term developments in the macro picture that's assisted equity markets. Probably the most significant was the commentary out of the G8 encouraging the ECB to do everything possible to ensure that Greece remains part of the Eurozone, and that's probably the single piece of news that's added some end to the selling that we saw last week. And if you go back to last week's webinar, I'd highlighted that we were probably getting close to a point where the flow of bad news was soon going to be balanced or counteracted from a response from sort of global leaders, either around the euro bond possibly re-emerging and the probability of reducing discussions around austerity and focusing more on growth, and both of those things have started to come through the news flow over the last sort of 24, 48 hours. If we go to the graph on screen here, so in tonight's presentation we have a number of new listeners joining us for the first time, so I'll endeavour to balance the delivery of new content for our existing clients with that of the new clients that are joining that will need some level of sort of recapping on some of the issues that we've covered in previous week's recordings. So just to jump to this macro analysis, so we form a view on the overall portfolio based on our certainty around US earnings, and to simplify the macro outlook on US earnings is the S&P 500 historically trades at 14 times earnings. Given the global indebtedness of Western economies, there's an ascribed discount to PE valuations throughout all Western markets of around 20% at present. So fair valuations for the Dow's around 12 times earnings rather than historical 14 times earnings, and I think that's something that's going to stay in place for quite possibly a number of years yet to come. So then we go from, well, where did the earnings sit? If you go back to the December quarter, S&P 500 companies delivered roughly $25 of earnings for the December quarter. When you consider that, take into account the volatility that we had from sort of that October through to December period and the slowdown that we had in September, August and September at a global macro level through the economy, and that was the last time that we sort of had these Greek issues and peripheral European indebtedness issues, and that was well and truly prior to the ECB providing the liquidity lines into the European banks. So even in the face of that, the S&P 500 for that December quarter delivered $25, so an annualized earnings rate of $100. Then we move into the most recent earnings result in the US, which came out in the March quarter, and again S&P 500 companies delivered on average $25 of earnings. So the run rate of $100 earnings per share is intact, and when you times it by a 12 times multiple, it works out the fair value for the Dow Jones is 12,500 points. If you bring that across to the XJO fair valuation for our markets, around 4,400 points. Now the Dow's pulled back to what we consider to be fair value now. Essentially what we had throughout this period here was not an increase in earnings power of the S&P 500. What we had was essentially an increase in market confidence, where we started to see some PE expansion, where the market was happy to pay in advance for earnings growth out to 2013. And I think still analysts are looking for around 10% earnings growth in the US. That may be reduced a little in light of the problems in Europe, and I think that becomes especially so if the Greek elections in June are not a favourable outcome, and we ultimately see Greece leaving the euro, which is not our base case, but if that was to happen, then I think the probability of 10% earnings growth in the US diminishes. If there is the assumption that the 10% earnings growth is in fact achievable, then fair valuation for the Dow 12 months out becomes 13,500 points. So we don't see that the US really has the opportunity to trade too much above 13,500 points for the rest of this year, and we certainly think on the downside it could easily trade down into sort of 11,500 or 11,700 points, which is roughly another 5 to 8% below where we are at the moment. But again, our base case is it's just pulled back to fair valuation, and arguably it should trade sideways from here until these Eurozone issues are resolved. And we don't know whether that's 1 month away or 6 months away. The next key date is middle of June for the upcoming Greek referendum. And that's essentially a vote by Greek citizens as to whether they ultimately want to stay in the Eurozone or not. So at a macro level, I think I'll move on to the next slide, just being the Shanghai index and composite. So again, just to recap some of the data we've discussed over the last few months on the Investor Signals webinars. Shanghai, we have a view that has largely gone through its risk adjustment. Inflation was running at around 6.5%, and it made it very difficult for the Central Bank of China to provide too much stimulus to the economy. We've seen a slowdown that arguably has been predicated on a slowdown from Europe, but also from probably an overheated property market in Asia. I think now what we're seeing is inflation come down to much more sustainable levels at around 3.5%, and we're seeing the central bank starting to ease the reserve requirements for Chinese banks, which is essentially meaning they're moving into a more stimulus sort of type environment for the economy. So we're of the view that the bulk of the risk adjustment's already taken place and price largely moves sideways. Data in the March quarter was reasonably strong. China had record steel production. They had an increase in loan growth. Electricity consumption was up, and then we've seen a fall off in that data during April and the early parts of May. But I still think we're sort of bouncing along the bottom, and that'll ultimately provide a sort of support level, and when we get 6 months out, we'll look back and recognise that this was a reasonable buying opportunity for not only Asian equities and assets, but our bulk commodities here in Australia. The big influence for international money flows at the moment has obviously been the euro dollar, and what we're seeing here is not only capital leave Greece, Ireland, Portugal, potentially Spain, Italy, but we've seen a significant shift of euro dollars back into US dollar denominated assets, and in particular US bonds. So the 10-year Treasury in the US is trading down on a record low yield of around 1.7, 1.8%. As money moves out of the euro dollar into the US dollar, it puts a squeeze on the carry trade, and what we start to see is money leaving risk assets like commodities and commodity-linked currencies. So the real risk here for global markets still remains that if Greece was to essentially vote to exit the euro in its June referendum, the probability of the euro dollar being forced lower on the back of further funds flowing out of Europe into US dollars continues to put pressure on the risk-off trade, like what we've been seen in place for the last number of weeks. Now, the truth of the matter is it's extremely difficult to know what the ultimate outcome will be with Greece. But what we do know is that we're closer to the end game than we are at the beginning. I think whilst there's a risk that obviously if Greece leaves the euro, that potentially Ireland, Portugal, to a lesser extent maybe Spain and Italy, although obviously that's where the risks lie, that creates a lot of uncertainty. But we have to have some comfort from the ECB and the G8 meeting that it's clearly not the intention of global leaders to have that as an outcome. So we assume that the euro is reasonably close to some level of support. Even in the short term, across the last 48 hours or so, we've seen a little bit of money coming back out of US dollars and flowing back into risk assets. We've seen the Aussie dollar move a little bit higher and commodities being a little bit more supported over the last 24, 48 hours. Okay. The impact that then has on our local market is essentially we're trading, our industrial stocks are trading at 14 times earnings. Our resource stocks and our banking stocks are trading anywhere from 8 times to 10 times earnings, and we get an average PE of around sort of 11.5 times earnings at the moment. As we move through the top 50 stocks tonight, we'll have a look at which companies are likely to deliver earnings growth, and we put a number to that as to whether they're growing at essentially flat earnings, 5% earnings growth, 10% earnings growth, and we start to single out the names that we see have bankable and defensive earnings growth over the next 6 to 18 months. From our domestic market, the key question becomes, is 4,000 support, and are we able to hold this level and move higher, or do ultimately we break and trade lower? Now, the orange or red rectangle that we have in the background on the graph here essentially indicates where we see that the XJO will spend the bulk of its time trading throughout 2012. 4,400 against fair value based on the Dow where it sits at the moment, given that we obviously have a heavy allocation to resource stocks and our banks have gone ex-div and the banks have come under pressure a little. We've had sort of a slightly more aggressive sell-off. We're down roughly 10% over the course of the past fortnight, and the US is down roughly 7 to 8%. The issue being is that we never obviously had the same leverage to the upside as the US market has enjoyed over the past number of years, and that's been a result of the high Aussie dollar, high bank funding costs, just to name a couple of headwinds that the Australian markets had to work against. What we're seeing is the Reserve Bank of Australia drop interest rates. We're starting to see the Aussie dollar come down. So some of those headwinds that we've endured over the past 24 months or so are starting to abate, and we maintain our view that whilst the US market could move another 5 to 6% lower on a negative outcome with the Greek referendum, our market is at risk of trading down to 3,800, but our base case is that it spends the most part of the next 6 to 12 months trading between sort of 4,050 up to sort of 45, 4,600, but fair value again back at 4,400. Okay, so moving straight into the top 50 graphs for tonight. So AGK has been one of the defensive assets that we've held in client accounts, and our view here on AGK is that the stock provides roughly about 8 to 10% earnings growth over the next 12 months, which when you go out to 2013 means that we're buying AGK on roughly around 11 times earnings. Now the stock pays roughly a 4.5% dividend. Our total return on AGK on an annualized basis exceeds 25%. We were buyers of the stock at lower levels. We've managed to sell the covered calls a number of times and collect the dividend stream out of AGK. So we're really getting close to a stage where we're happy to exit AGK. We note that a number of institutions are only now just starting to add AGK to their model portfolios. We're sort of a little bit counterintuitive, I guess, as we start to see money rotating into some of these defensive assets. What we're looking to do is take the profit that we've enjoyed from over the last 6 months or so and actually start to look to rotate that free capital from delivering these shares into some of the more punished cyclical stocks. And as I move through the top 50, I'll comment on that tonight. So in the case of AGK, we've sold the $15 calls into June, and a great outcome would be if the stock maintains $15 plus and we're able to deliver the stock and again lock in roughly sort of 20 to 25% capital gain on AGK. Okay, Asiano is a stock that's crept onto our radar. We've always been cognizant of management's bullish forecasts, and even at the most recent numbers following the March quarter, management maintained that they're still looking for 15 to 20% earnings growth over the next 3 years. Even if we ratcheted that back to sort of somewhere more in the order of 10%, we have Asiano trading on roughly sort of 11.5, 12 times earnings out to 2013. So again, it becomes attractive. It's on our radar, but we haven't set new positions in Asiano at this stage. Amcor is one of these defensive names that we've participated in for the last almost 2 years as a regular sort of trade within our investment portfolio, and the most recent allocation of Amcor came when we bought the stock at roughly $7 and we sold the $7.50 calls into June. So again, we've locked in roughly about 8% or so of capital growth in the investment. We collected the dividend in the February-March period, and then happy to deliver the stock. So we're looking for Amcor to maintain above $7.50 going into the June option expiry. Now the reason why we've liked Amcor is that a big part of its revenue comes from packaging for food, tobacco and cigarettes. The company's delivering 10% earnings growth. We see a big part of that earnings growth coming from the cost synergies that they've achieved from the Elcan acquisition. And as a strategy, the company's doing a good job of small bolt-on acquisitions in emerging markets, which is delivering sort of 10 to 15% earnings growth in some of the faster growing economies. From a PE valuation, the stock, assuming it delivers its 10% earnings growth over the next 12 months, which we're confident it will do, buying the stock at around 13 times earnings, which makes it a reasonably fair value industrial play. So our strategy here is to continue to own Amcor. by delivering the stock at $7.50, again, it's a name that we're locking in excess of sort of 20% annualized returns on Amcor, and we're definitely buyers of the stock on any pullback into that sort of 725, 730 range as we sort of move into the August-September period if an opportunity presented. But Amcor's certainly a name that we like and intend keeping exposure to the stock across the next sort of 12 to 18 months. AMP, on the other hand, has been a bit disappointing. We're not significant owners of AMP. On a 12-month outlook, I think AMP will be lucky to deliver earnings that match the prior 12-month period. The issue here with AMP is the cost synergies from the AXA acquisition have essentially been eroded through loss of business at the margin, as management has attempted to integrate AXA into the AMP business. But ultimately, long term, the larger footprint that AMP has as a result of the AXA deal, I think bodes well for AMP as retail and consumer interest in share market and equity markets pick up, and whether that be 24 months out, it's hard to know. But ultimately, AMP, I think across the next 6 to 12 months, revenues and profits will be flat. The stock's trading roughly 10.5 times forward earnings, delivering a dividend yield of around 7%. So in an environment that earnings remain flat, the stock is interesting purely as a very tight buy right, where we're happy to sort of buy the stock at or near these levels, sell the $4 calls. It'd be a European-style call, and we collect the dividends and the premium and have a view that it will deliver around 10 to 15% earnings growth, and majority of that coming from the cash flow, the dividend, and the option premium rather than an actual improvement in the underlying asset. ANZ, so the banking sector for Australia, I think we kind of view this almost as a utility style asset at present. Australian banking sector is unlikely to deliver any significant pickup in loan growth. Their cost of funding is creeping up. They're endeavouring to fund more of their funding requirements from paying up for deposits, so as a source of funding that becomes a higher marginal expense, and as too does funds that they're sourcing offshore gradually creeping up, and especially of recent times with the added round of issues coming out of the Eurozone. Now, so to offset that, obviously what we're seeing is the RBA ease rates. Banks are holding on to some of that. So we're pretty comfortable that the Australian banking sector delivers flat earnings growth across the next 12 months. So it really becomes a yield play. Australian banks yielding roughly sort of 7%. So in the case of the most recent derivative strategy on the banks is that I think we did a pretty good job of identifying the top in these banking stocks. We'd sold European call options, so we collected the premium from the calls and we collected the dividends, and we're just starting to move back in to ANZ at the moment. But broadly, any exposure to the banks has been shifted across to NAB, and we hold NAB for the upcoming dividend. ASX, so at the margin, slight decrease in both revenue and profit by 1 or 2% from the same corresponding period when we look at the March numbers. The issue with ASX really is that at best they're going to deliver flat earnings growth across the next 12 months. What becomes attractive with ASX is market volumes are already down 20-odd%. The probability of market volumes falling significantly below sort of where they are at the moment, I think, is fairly limited. So we're comfortable that we're not overpaying for ASX at a 14 times multiple, delivering a 6.3% yield. But again, like AMP, it becomes a name where you have to sell the tight covered call to achieve the annualized return to justify the risk. So in the case of ASX, we're owning the stock at these levels and we're selling the $31 European calls where we're locking in, so the 80-90 cents dividend collecting roughly the same in option premium, and it's delivering roughly a 15% annualized return from a cash flow standpoint, and providing what we think is fairly limited downside risk from where we sit at the moment, from respect of revenue forecasts and profit forecasts over the next 12 to 18 months. So ASX is a stock that we like. Not doing anything there. BHP, now on all metrics, the bulk commodities are cheap. What's important to realise is that whilst iron ore only makes up one small component of BHP's revenue, I shouldn't say small component, relative to Rio, I just try to put into perspective sort of what it means. So we've seen iron ore prices fall from roughly 140 a tonne back to around just sub 130. So let's just call that 10% fall in iron ore prices. For every 10% that iron ore falls, BHP is likely to be impacted somewhere in the order of sort of 7% on the bottom line. So that means, all things being equal, their forward 12 months earnings outlook's going to be sort of 7 to up to 10% below from where it is at the moment. In the case of Rio, it's sort of more like 10 to 12%. So you can understand when iron ore's gone from trading at 160 down to where it is at the moment at 130, why we've had the large price adjustment in these bulk commodity names. Now, given our macro view on China, and we think that it's going through a basing pattern, and as we get sort of 6 to 12 months out, we think that we look back and recognise that these bulk commodity names are good value. Now, we've been fortunate to sell call options regularly throughout this downtrend, which has provided a little bit more cash flow from these names. So BHP is only delivering around a 3% dividend yield, and whilst there's been speculation that the market that we may see increase in the payout ratios for these resource stocks, we just don't share that view across the next 12 months. So you need to be selling call options to justify having your capital tied up in these names. From a cash flow standpoint, we're delivering roughly sort of 6% cash flow out of BHP, and the reason why that cash flow is down significantly relative to, say, Amcor, is that we're allowing a lot more upside response in BHP and the bulk commodities, and in particular our bias in portfolios is towards oil and gas and iron ore plays. So in the case of BHP, we're looking for a recovery back up to around $40 into the back half of this year, so we wouldn't want to stifle that recovery by selling calls at too low a strike. Brambles, so a little like Amcor, this provides a fairly defensive contribution to the portfolio, trading at roughly sort of 15 times forward earnings. We think Brambles is one of those few companies that will deliver bankable double-digit earnings growth, so something in the order of 15% earnings growth over the next sort of 12 to 18 months. And we're happy to be buyers of it. So even right in the market environment at the moment, we see Brambles as good value, anywhere around this sort of $7 level. Our strategy is to sell the 750 calls into December, collect the upcoming dividend of roughly 16 cents plus the premium from the call option, and if we were to get into December and see Brambles trading at 750 plus, it becomes another name in the portfolio that delivers sort of somewhere around 20 to 25% annualized earnings growth. CBA, so the March quarter update out of CBA came in, I think, at a level that slightly disappointed the market. I think the market was looking for high single-digit earnings growth out of CBA, and essentially it came in flat. So I think the premium that's been ascribed to CBA trading on a higher multiple at roughly 12 times earnings in comparison to the other banks trading 10.5 times starts to get unwound a little. So we just simply see CBA trading sideways from here. We'd sold the $52 calls into May and June. They wind off, and that obviously complements our 7 or 8% dividend yield and starts to deliver an annualized cash flow out of CBA of around 15%. And we're happy to look at resetting that into that $52 level into the back half of the year. Coca-Cola, so this is a name where I've chatted a little bit about yield trap. So following the recent interest rate cuts by the RBA, there was a huge flow of capital into defensive assets that were trading sort of on yields at around 5.5 what we're now seeing is those yields compressed down into the 4.5 range. When you take into account earnings growth for Coca-Cola's probably only going to be between 3 to 5%, it's hard to build a case that the stock's worth too much more than sort of $13 at the absolute top. So we think the stock largely trades sideways at or near this sort of $12.50 level from here. But certainly for new money coming into the market, an opportunity to buy Coca-Cola at around $12.50, sell the $12.75 calls, provides again a defensive asset that's delivering roughly 15% cash flow over a 12-month period, with the prospect of some capital gain if the stock was to rally from $12.50 to $12.75. Computershare is one of the growth assets that we like, so the BMY Mellon transaction that has taken place has given Computershare a much bigger footprint in the US. As we get into the August reporting season, we think we start to see the first 6 months of the benefit of the BMY transaction, but the story for Computershare really is more 12 to 24 months out, and we see it as a buy on the dip story. So any opportunity for new money coming into the market to buy Computershare down at these levels, I think, represents good value. We've largely sold the 8.25 and 8.50 calls. We've collected the dividends, and again, it's something that if the stock was to rally back up above 8.25, we're locking in roughly sort of 20% annual gains on Computershare. At this stage, we assume that the stock finishes May option expiry, which is only a few days out, below 8.25, and we get the opportunity to rewrite those calls. But the broad view on Computershare is we think sort of when you get 12 to 24 months out, they start delivering 10% plus in EPS growth, and that becomes a bit of a rare group of stocks in the current market. CSL is one of those ones that certainly fits that rare group, 10 to 13% earnings growth. The sliding Aussie dollar aids in the conversion back to Aussie dollar earnings. The company's conducting a $900 million buyback. Expect them to remain fairly aggressive over the next few months as they conclude that buyback. We bought CSL at lower levels. We're locking in roughly close to 20% gains in CSL. We're certainly not buyers of the stock again until it pulled back to around $34.50. Crown Casino, so at $9 it trades at 16.5 times current earnings. If we allow for 10% EPS growth into 2013, which we think is reasonably bankable at this stage, given the gaming data that the numbers that are coming out of Macau at present, puts Crown on 14 times multiple, which I think is about right. So it really just becomes is 10% earnings growth an ongoing trend? And if you're of the view that sort of China's going through a basing pattern, then yes, that's probably quite likely. So the trading range for Crown probably now shifts from 8.50 up to 9.50. But we're not doing anything Crown on the internal portfolio ourselves. So Fortescue we like. So again, this is an iron ore story. So at $160 US a ton, Fortescue's worth $6 a share. At $130 a ton, fair value for Fortescue's more around sort of $5 a share. We've largely sold call options around the 550 level, so it's delivered a cash flow yield out of Fortescue getting close to 10%, but it really is one of these value opportunities, a little like BHP, where we see that into the back half of this year we could see a snapback in Fortescue's valuation, where it's trading north of 550. IAG, I think from a PE standpoint, it's reasonably expensive. At best, we just simply see the stock trading sideways, but not a stock that we're too active in. Iluka, other than to say it's on the radar, a number of brokers are upgrading their outlook for Iluka, so it's one that we start to look at a little bit closer, but not doing anything in our internal portfolio or client accounts. IPL, I'll just go to some specific data here on IPL, so I'll just get you to bear with me a moment. But IPL is a stock that we certainly like. We've sold the $3.40 calls, which has helped to deliver a cash flow yield out of IPL of roughly sort of 10% combined with the dividend, whilst we wait for a recovery in the underlying asset. So I'll just go to some notes here. So Incitec Pivot's first half 12 result was below most analysts' expectations. So a strong performance from the explosive business, including a rebound from the impact of the Queensland floods in the first half 11, was offset by poor fertiliser results. Fertiliser earnings fell due to extended repairs at the Mount Isa acid plant and trading losses precipitated by the sharp fall in global fertiliser prices in 2011. While the commissioning of the production from the new Maramba ammonium nitrate plant will boost earnings in financial 13, we expect this to be offset by further weakness in DAP prices and US coal explosives demand. Now, our view on DAP prices is, whilst we're seeing this rotation out of the euro into US dollars, it puts downward pressure on all commodities, and DAP prices included there. But ultimately, we see that the low inventories throughout the US should be supportive for fertiliser prices, and we see DAP holding up at around 500 US a tonne. Now, in that environment, along with the commissioning of the Maramba plant on time, which, to put some numbers to that, the Maramba plant could potentially add, up to another $150 million of annual earnings before interest over the next sort of 3 years. So it's a significant investment that IPL's made, roughly $1 billion, and over the next 2 to 3 years it could really start to have a significant impact on the bottom line of the company. So total revenues rose 9% to $1.6 billion for the first half 2012, but the issue being that the bottom line fell by roughly 20% from the same time last year. And net profit after tax fell by, as indicated on screen there, roughly 15%. So we're of the view that we're getting pretty close to the low within the business cycle for IPL, and we'd expect to see this as a reasonable buying opportunity at or near these levels. In the case of Leighton, it creeps onto the radar, and we think it potentially becomes a buy on the dip story over the next 3 to 5 years. The most recent announcements from Leighton backs up their full year forecast of roughly sort of $400 million profit. The Q1 net profit after tax was down $80 million, and this was impacted by write-downs of 178, so essentially delivering roughly $100 million in the first half. Whether we get up to $400 million for the full year, we'll have to wait and see, but management have reaffirmed that that's their expectation. On that basis, Leighton trades at about 9.5 times earnings, which is roughly in line with its peers at present. Lendlease within the property sector trading roughly 9.5 times earnings. We think it's probably one of the more defensive opportunities within the property sector at the moment, but not doing anything in our internal account. Macquarie Group, I've spoken in detail about this. The company really has to deliver a pretty impressive second half earnings result in order to meet their 12-month target. We're concerned that a number of the items in the first half were one-offs that may not necessarily be repeated. So I think take away the 500 million share buyback, and I think arguably Macquarie would be trading lower multiples. But this really becomes a trade where we're speculating on whether the outcome for Greece is going to be positive and the risk on trade is loaded across the board, in which Macquarie becomes sort of a 12 to 24 month opportunity to be set in sort of a stock that would give you leverage to an ongoing global recovery. For our money, we just find that risk a little bit too unpalatable relative to taking exposure in the Australian banks and collecting the dividend and selling the tight covered call rather than being in the investment banking space in Macquarie. So NAB's our preference there. So we're owning the stock at the moment, heading into the end of month dividend of roughly 90 cents. We've sold the 26.50 calls into September, so we're happy to deliver the stock if we were to get a resolution in the Eurozone and the market was to rally. Otherwise, again, when you add in the dividend yield plus the premium from the options, we're achieving roughly 15% cash flow on a standstill basis from holding NAB. Newcrest Mining, so the story here with Newcrest is really one of lower production. They were originally running at 20% below their previous production peak, and then management came out recently and guided to a further 10% downgrade. Combine that with the fact that money's flowing out of euro into US dollars, and you've got the downward pressure on gold. Newcrest is very out of favour at the moment, but we're of the view that fair valuation for Newcrest is back up between $30 to $35, and that's just assuming that gold stays within a band of roughly around $1,200 to $1,600 an ounce. Arguably, valuation on Newcrest now is factoring in gold, closer down to sort of $900 to $1,000 an ounce, and we just don't see that as the outcome for the next 6 to 12 months. News Corp, big point of interest here is that obviously the News Corp board's upgraded their share buyback from $5 billion to $10 billion. They're pretty close to concluding the initial $5 billion by the end of June. They're about 85% of the way through that. But when you start putting some numbers to the cash flow with News Corp, even if they are to complete the second round of buyback over the next 12 months, they still end up with a cash position of almost $10 billion following what would have been a total of $10 billion share buyback. Their earnings growth looks impressive, but I think the probability of that continuing at that same run rate is limited. So News Corp for us just becomes a story of, is the risk-reward ratio right to own News Corp, sell a tight covered call? On our analysis, we can deliver around 3% growth out of capital growth, and combined with the call premium out of holding News Corp for about 6 to 8 weeks. So on an annualized basis, again, it starts to get up to around 18 to 20%. Now, we wouldn't be participating in that trade because we were necessarily overly optimistic on the earnings profile of News Corp. It's more a view that we probably don't see the earnings growth under too much pressure, but what we do see is the stock price being well supported by the share buyback. But our view here for News Corp is the stock largely trades sideways. Origin Energy, from a PE standpoint, the stock starts to drop down to around sort of 14 times earnings on forward earnings, which makes it attractive. The real overhang here for Origin is a funding issue, and I think the board certainly needs to look at selling down further interest in their LNG projects, and we'd expect to see something announced on that over the next 6 months. Fair valuation for Origin arguably is back up at around $13.50. We see it too low to be selling calls at these levels. New money coming into the market, happy to buy Origin. We think on a 12 to 24 month outlook it will deliver 10% earnings growth. I think once we get rid of this potential capex requirement that the company has on their LNG project, and that'll again be removed either by the company doing a share placement or a sell down of their interest in the LNG project. I think either way that'll be resolved throughout 2012, and it should mark a sort of a low point within the valuation cycle of Origin. Not here in Orica at present. Oil Search, I think it's certainly, you can see there that we've identified it as a value opportunity. I think Oil Search, Santos, Woodside Petroleum all remain attractive in the face of this current sell-off that the market's endured. The story here for Oil Search is that the LNG development progress over the next 12 to 36 months will continue to provide sort of positive news flow around Oil Search. Santos is probably slightly more appealing on valuation grounds, but Oil Search, we're buyers of it at or near these levels, and we're sellers of the stock back up at around $7.50 on any recovery. Qantas, not doing anything there at present. QBE, just a quick snapshot here. If we go back a few months ago, we started to get a little bit negative on QBE. We took advantage of the timing with selling covered calls. At this point in time, US 10-year treasuries were running at around 2.5 or 2.3%. We're now trading 0.5% lower at 1.75, 1.78, and that simply just eats away at QBE's free sort of risk-free rate of return for their premiums that they have on deposit. In light of our view that we think global markets are getting fairly close to a troughing pattern, we start to see QBE as reasonable value here, but the issue just still remains that management's continued to disappoint, and there really needs to be a period of the stock flattening out and delivering on their promises before we really get overly aggressive with QBE. QRN, I think, starts to look attractive from a multiple standpoint. We saw it as expensive up here. We're owners of the stock at lower levels. We sold it up at sort of $384, and we always had a view at around $325, $330. It becomes interesting again. I don't think it's going to be a stock that runs away. I think it will consolidate across the next few months at or near these levels, but certainly one that's on our radar. Rio, as with BHP, we see a sort of deep value down here, and we think we get into the second half of this year and see Rio trading back up towards $70. Stocklands, from a PE standpoint, trading roughly 9.5, 10 times forward earnings. We see limited earnings growth out of Stockland, and the attractiveness of Stockland is it pays roughly a 7.5% yield, so it really becomes one of those names where you're happy to own the stock, but you have to sell the tight covered call, and you're starting to deliver roughly 15% cash flow growth out of Stocklands. Sonic, not doing anything there at present. Santos, as with Oil Search and Woodside, we see it deep value down here, and we've been buyers of it in the last few days. We're looking for Santos to trade back up to around fair value at about $13.50 to $14. So Suncorp, not doing anything there at present. Sorry, just let me reset this. Suncorp, not doing anything there at present. Sydney Airports is a stock that we've owned, so we've purposely had a fairly defensive allocation in both our internal account and client accounts. We've been overweight names like CSL, Amcor, Brambles, Sydney Airports, Woolworths, Wesfarmers, ASX, and a lot of these names have held up very well in the face of a market that obviously, if you had any exposure to mid-cap resources or any exposure to retail, portfolios have been significantly damaged by exposure to those names. Sydney Airports is a stock that we've had in most client accounts. We've owned the stock at lower levels. We sold the 290 calls. Again, it's a name that on an annualized basis delivered roughly 20% earnings growth. We see the stock pretty close to full value and just trading sideways from where we are at the moment. Transurban, from a yield standpoint, it's attractive. The issue here is we just don't see significant earnings growth in Transurban over the next 12 to 18 months. The yield that's being paid pretty much soaks up all the profit that's being generated in Transurban, so whilst it is a dividend that's fully covered by profits, we don't see any margin for management to increase that dividend stream over the next 12 months. So at or near these levels, it's pretty much full value. Telstra, so our strategy here is to sell the €3.51 into September. So what that means, again, if you're listening for the first time, is a European option can't be exercised until expiry, whereas an American-style option can be exercised at any time. So where we have assets that we don't want to put the dividend at risk, we sell European options, and in the case of Telstra, we achieve roughly 11 cents for the September euro. So on our analysis, what that means is we essentially lock in the full potential of capital growth in Telstra up to around sort of 380. We're protected on the downside to around sort of 340, and on a standstill basis, if over the next sort of 3 months Telstra largely trades sideways, what we've done is come close to doubling the dividend yield out of the stock, given that we achieved roughly sort of 11 to 12 cents for that call premium, and combine that with the 14-cent dividend for the 6 month on an annualized basis, we're getting up to around 15-16% cash flow out of Telstra, even in a situation when the stock trades sideways from here. Toll came out with an earnings miss, and essentially that earnings miss just means that all the upside that analysts started to get bullish on Toll has evaporated. Over the next 6 to 12 months, earnings at best is going to match what they've been doing throughout 2011. When you ascribe a fair PE to that of roughly 10 times, we're not surprised that valuations on Toll sit at around 420, but we think this is probably the low point in the cycle with Toll, with them taking action on jettisoning lower and underperforming assets within the business. Combine that with lower interest rates here in Australia, I think the probability that Toll gradually starts to perform better from these levels becomes something that could be a kind of a real outcome. Westpac, the banking stocks, Westpac probably surprised a little more than the others, but at the margin the banking stocks were all very similar, so our view doesn't differ from one bank to the much too greatly. So our view on Westpac is the stock trades sideways, 7.5% yield, need to be selling covered calls up at around the $22 level. Happy to deliver the stock on any sort of bullish move in the market back up to that price point, but again you need the call option from those premiums combined with the dividend to really warrant holding these banking stocks. As our base case is they probably not too much higher. Even if you go 6 to 8 months out, we don't see the banks trading sort of too much beyond where they are at present. And likewise with Westfield, earnings growth is limited, maybe 2% EPS growth, trading on a 5.5% yield. We don't see it trading too much lower, so the stock trades sideways at or near these levels. Wesfarmers, again, maybe 5% earnings growth would be a good outcome for Wesfarmers over the next 12 months. At 14 times forward earnings, it places the stock pretty close to fair value. We've sold the $31 European calls, which essentially gives us upside in Wesfarmers into September up to about $32, and we think that sort of caps the upside potential there. And like many of the other names that I've spoken about tonight, what that means is instead of achieving sort of a 5% yield out of Wesfarmers, we're achieving somewhere in the order of sort of 12% cash flow out of Wesfarmers, and also giving ourselves the opportunity for roughly sort of 7% capital growth in the underlying asset as well. Worley's not doing anything there at present, albeit it's a stock that's come onto the radar. We see it as a value opportunity, but our preference is to allocate capital towards the oil and gas names themselves. Woolworths, so we've been buyers of it at lower levels. We see fair value up here around sort of $26.50, and that's based on sort of 13.5 times forward earnings. Limited earnings growth, only about 3 to 5% earnings growth over the next 12 months. On a 2-year outlook, I think Woolworths becomes very interesting from a cost-cutting point of view, and we could certainly have a base case where Woolworths trades up towards sort of $27.50 to $28.50, but certainly across the next 6 months we see it trading sideways at or near $26. So like Amcor, it becomes a defensive asset in portfolios where we're selling tight covered calls, collecting the premium and collecting the dividend yield out of Woolworths. Woodside Petroleum, deep value down here as Pluto starts to come online in the back half of 2012. We think the gradual fair valuation for Woodside is recognised, and the stock trades back up towards $40 and not doing anything there in WRT. And there we are, back to AGK. So just to conclude tonight's presentation, there's a lot of information to try to get through in light of the fact that we have listeners joining us for the first time tonight. But I'll just conclude with a quick look at the XJO and summarise our short-term outlook on the market. Now, as discussed at the beginning of the presentation, we still maintain that fair value for the XJO is 4,400. We've had a view that obviously we're heading back down to sort of this support level here. We've been, from a portfolio allocation, we've been overweight the defensive assets, writing tight covered calls and driving sort of above average cash flow returns out of those, and we've had minimal exposure to the bulk commodities. But as we start to deliver some of those defensive assets at or near our price targets, we'll look to rotate some of that capital back into some of these value names, and we would sort of ride those value names out to sort of September, October, with the hope of delivering sort of them at 10 to 15% capital growth levels beyond where we enter those names, and so that'll gradually start to change the skew in the portfolio from sort of these higher yielding defensive names into sort of some of these cyclical names that we see presenting value. Right at the moment, that would still mean that we'll keep exposure to your Amcors on a pullback, CSLs on a pullback, but right at the moment, some of these oil and gas names and the iron ore plays we do see are starting to present some interesting value. The real issue for the market becomes sort of what is the outcome of this upcoming election in Greece and the implications that that has for the Eurozone. And until then, we keep our sort of defensive bias in portfolios, which runs up to sort of that last week in June anyway. So as we get into the conclusion of June, we can kind of review some of these thinking to see whether the current market activity supports a rotation out of those defensive assets. But it's something that's on the sort of radar. That's quite a possible outcome that we see. So thank you for listening in to tonight's recording. I look forward to speaking again next week.